value on the buy, growth once we own. That's kind of my approach in Techland is let's create, something that's got, real downside protection with cash flow and purchase price. But let's make sure that now that we own it, it's a tech company and we're gonna have to exit it to a buyer who's gonna get excited about the terminal value and the growth for them.
Hi, everyone, and welcome to KindredCast, where we shine a light on the people and ideas shaping our future. KindredCast is a production of Kindred Media, powered by LionTree.
Welcome to KindredCast, our LionTree podcast. I'm Antal, Runnebom. Today we continue our series of private equity investing in the technology sector, following this summer's conversation with Brian Reuter at Permira on the emergence of the software buyout industry. In the second installment, we're diving into the world of private equity and tech investing again with Reed Rayman, who is a partner in private equity at Apollo Global Management, who focuses primarily on investing in the technology space in addition to certain sectors in media. Reed has been at the center of some of Apollo's most high-profile deals in the technology sector, ranging from Western Digital to Intel, Shutterfly, Expedia, Simpress, ADT, and of course Yahoo. Reed joined Apollo in 2010, following the start of his career at Goldman Sachs. In today's conversation, we'll dive into Reed's journey at Apollo, Apollo's approach to investing in the technology sector. We'll talk through some of Reed's deals that demonstrate the breadth of Apollo's solutions, and we'll wrap up with a conversation on investing in the technology sector in 2025. Welcome to KindredCast, Reed.
Thanks for having me. My first podcast.
Fantastic. Very excited. Tell us how you got started in private equity and what led you down the path of investing in the technology sector.
So originally from New York, went to public school in New York, went to Harvard. I started at Goldman doing investment banking. I was actually in the industrials group in investment banking, and I was chugging the Goldman Kool-Aid. I never thought I wanted to leave. I loved Goldman Sachs. I didn't understand why anyone worked anywhere but Goldman Sachs. And so then I moved over in 2010 to the on-balance sheet hedge fund called GSPS after my 2 years in industrials investment banking. And I thought, it was just great. It was called, it was the former Risk Arb group. It was this super exciting group that I thought I was joining the best seat at Goldman. It was, I thought it was this, thought I was the man. It was the worst timed career move ever because so I moved over in June 2010. In July 2010, I think the Dodd-Frank bill passed. They had the Volcker rule. And so this was the group that got Volckered. So we literally, a month after I got there, we were getting shut down. And so here I was. I thought I was this young hotshot, basically out of a job. And I think it just shows you that careers are not linear. And so back then, Apollo was really small. We were there was one woman. She's terrific. We're still in touch. Who's the entire HR department. We were probably 150 people at the whole firm. Next thing you know, that fall I'd started Apollo. And so that that was the fall of 2010. Again, back then, firm was probably 30 billion or so of AUM, and vast majority of that was private equity. So the arc to getting into the technology sector. So look, when we started, as associates, you're a generalist, and so my first 4 years, I worked on a lot. So I actually worked on a lot of things across the industrial space randomly, and I was an associate. So we didn't do a lot of tech back then. It's a good lesson. One of the things I tell our guys now is, especially as associates, not about working on the sexiest deals or working on, the sectors you want to. It's working on getting the best reps with the best people. So my busiest deal, I would say, for 4 years, for basically my entire associate years was a small paper company we owned, but we did so many different interesting things with that company. And the principal on the team was a guy named David Samber, who now co-heads our equity business. The partner on the team was our guy named Scott Kleiman, who now is the co-president of the firm. So just one of these, as a young guy, you get really good reps with great people. And so then I'm getting to the answer of how I got into technology. So then back, and we'll talk about the growth in the firm, but from the private equity side, we really did not invest in tech back then, right? We were a value-oriented, contrarian firm, and of the sectors that we didn't touch, tech was one of them. And as I got into my principal years, we as a firm started opening the aperture a little bit about what it meant to be a value investor and how you can do value investing in technology. And so, we then, some of these are my partners, some of these are me, but did a whole slew of whether it was tech data, Rackspace, Shutterfly, Expedia, Simpress, Yahoo. We'll talk about them, but next thing you know, we're finding ways to be, kind of value investors in the tech space, and we've got a great franchise, and I love it.
Yeah, that's awesome. Tell us a little bit about how Apollo has changed since you've joined, because as you said, right, very very dramatic increase in AUM across the firm, and new divisions and mergers since you've started. What's changed in the culture and approach at Apollo since you've been there?
When I joined, the entire firm was on one floor for the most part in 9 West 57th Street. We had about, I think in 2010 it was about $30 billion of AUM, probably about 150 people. And we weren't a public company. So fast forward to today, we have about 5,000 people, a little bit over $700 billion of AUM, $100 billion market cap company, and we've really innovated in a lot of ways, and it's an exciting place and time to be at the firm with Mark at the helm. It stayed the same in that in our private equity business, our core, we've stuck to our knitting. We are still, our funds have gotten larger, but the core, what it means to be doing private equity at Apollo has not changed materially. We're stuck to our knitting. Purchase price matters, value-oriented, contrarian, cash flow-oriented investors, small partnership, small team. Across the firm, it's been really exciting to be part of it, the growth, and it's been, we've been in business building mode. In 2008 or 9, we started a business called Athene, which, is obviously now a huge part of our franchise. It's our insurance business, which is almost $400 billion of our balance sheet of the $700 billion. But it means for us, we've got a massive credit business, massive insurance business, large hybrid business. We're in the secondary space now. We've got all sorts of innovative new products that we've launched, especially in the last couple of years. So it just means that for me as an investor at the firm, I just have this really broad toolkit.
Yeah.
And we'll get into it, but I can go to corporates now and talk about a take private. I can talk about a hybrid solution. I can talk about a pipe. I can talk about everything down to inventory and receivable financing. So it's a really exciting time to be at the firm.
Let's just spend a minute on the arc of your deal history. You went from industrials to semiconductors, and across that way. I mean, I think I first met you when you were looking at talent marketplaces. Yeah. Right. So getting your feet wet in the internet in the internet sector. You started with ADT and various deals that were a little bit more removed from the technology sector to then getting into the internet sector, kind of at the height of the consumer internet at the last decade, and then you pivoted further into semiconductors and hardware. That's a journey not a lot of people make, right? Across all these different spaces. How did you navigate that personally, and what drove you into these? What drove your ambition into these new spaces?
For the way we think about our sectors as a firm, right? So we've associate principal partner. At the associate level, you're really a generalist. At the principal level, you start to specialize, and you kind of work with partners on certain things, and you get to try. So I worked with a bunch of folks who were like-minded and thinking about tech and media and other parts of the world. And then as a partner, you specialize. And so, really is when I think I became a partner in 2019. And so that's when I, formally, co-headed tech with my partner, Rob Kelso-Ramos. And, as we, we're opportunistic investors, right? So that is we are not thematic investors. We don't sit here at the beginning of the year saying, I really need to do a deal in consumer internet because I've got this thesis. We are opportunistic in the way we go to market and the way we look at situations. So it's just a function of where we found really good risk reward over time. So it's nothing, wasn't intentional, wasn't deliberate. There's a time when there was really good risk reward in, as we talk about tech, in parts of consumer internet. And then there was some really interesting risk reward across semis, and then most recently, obviously we'll talk about COVID, and we were very active during the depths of COVID, and those, and then now, just given the various tools we have, they've been this year especially very relevant for a lot of semiconductor situations, where there's huge CapEx needs and huge opportunities for us to finance those.
You came into the pandemic having invested in CareerBuilder, Shutterfly, and then the pandemic hits, and consumer internet had a very, very strong start of the pandemic, and then it went the other way. There were other sectors within internet that suddenly shut down, like travel, and you had to navigate through that very, very difficult environment in your private equity deals that led to some fairly meaningful retracements. It also created new opportunities like Expedia, right, to be opportunistic. But that learning of going through that cycle, tell us a little bit about that experience and how you navigated it and how it's turned out.
I'm super proud of what of our investing experience and track record during the pandemic. At that point I had 2 young kids with a third on the way. I mean, like many others listening and that we all work with, it was a traumatic time with no childcare to be working literally 24/7 for at least all of March and April and May and thereafter in the depths of 2020. I think the most as it relates to the portfolio, we were fortunate. We had the chance to play offense more than we had to be playing defense, and so because of the stability of our portfolio and the way the types of businesses we tend to buy, we weren't playing that much defense. We didn't have to. And we could really focus on deployment. In private equity, we can do, we do opportunistic buyouts, we do carve-outs, but we also do distress for control. And so we can deploy into markets where there's a lot of volatility. We're not a hedge fund in private equity. Anytime we're investing in a credit out of private equity, there's a catalyst to control or a catalyst to a restructuring. But in those weeks of March and April of 2020, we invested about $3 billion of equity. And, I'll borrow a quote. Well, it's a Lenin quote that my partner David Sandberg loves using, but I love it as well. It's, there's decades when nothing happens, and then there's weeks when decades happen. And that's really what it felt like. And I think the big takeaway was being prepared. Probably in a several week period, right? Mm-hmm. I mean, we couldn't have started from scratch. So each of us, as part of being a partner in our private equity business, I've got a screen of all the credits in my sector, and I know exactly what my price target is for every one of those credits. And so when something like COVID happens, and the leveraged loan index falls 40 points, and things start, we were able to move really, really fast. So I was involved in a lot of our, deploying into the secondary credit markets. And then, we were able to take a long-term view, and I'm super proud of, within a 1 week or 2 week period of each other, I was fortunate to announce 2 separate, very large rescue financings, or capital solution financings. We did a $1.2 billion investment into Expedia, which we split with Silver Lake. And we moved very quickly in a matter of weeks, underwrote, that people were going to travel again, and took a long-term view, and that was a very, very successful investment for us, that Expedia investment. And they called us after a year, and then separately Simpress, which is another consumer internet business, or also B2B and consumer internet business. And because we owned Shutterfly at the time, we knew the space really well. We could move very quickly. And that was a $300 million investment, another very, very successful investment for us. So, it was hectic and scary, but also exhilarating, and we were able to put a lot of capital to work successfully.
This cuts to the core of some of your differentiation in the technology sector, where you're investing across the capital structure,
exactly,
across different points in the cycle.
Yeah, and they're very different. Expedia was a pref plus warrants. And Simpress was actually a second lien credit-like financing that came with warrants, so we had the equity convexity there as well.
One last point at the personal level. You've worked with some tremendous founders and leaders over the years at Apollo. What's a memorable moment that really touches the culture of the firm for you?
I'll give 2 examples of things that are kind of real bookends to date. Memory one, it's not one, but it's, I grew up, we were a firm with an apprenticeship culture. Meaning it's a very lean team. Like I said, 3-person deal teams for a very large pool of capital. and you learn by osmosis. And one great example of that is every single member of the investment team joins IC every Monday. So I grew up, my memories of growing up, sitting around the investment committee table, I was in the room while the partners and principals sat on the table, watching, the founders, Scott Kleiman and Mark Becker and other, guys that I, mentors and folks that I really grew up, admire and watch. I would watch them have intense IC debates. And my best learning experiences were often just being there on Monday mornings, being able to sit in as a young person when we were a really small firm and the whole firm sat around the table. Again, to be fair, today still in private equity, we do ICs that are open to everybody. Fast forward, another amazing memory on the other side of now the growth as a firm. This past January, Mark organized our first big partners outing, and he's talked about this publicly. We did it in Abu Dhabi. So we now have 200 partners, or thereabouts, and everyone descended globally on Abu Dhabi, and it was just an amazing, reflection. If I just think about everyone, and the camaraderie and the excitement now being part of this firm that has, reached this scale. Just an amazing experience, memories, Mark's leadership, and some of the discussions we had in Abu Dhabi. So really memorable.
That's amazing. So now we're gonna go over to Apollo's unique approach in private equity, and also around hybrid value and infrastructure finance, right? Areas you're touching in the deals that you've been working on recently. Let me spend just a second giving our audience a little bit of data on the Apollo platform. So, how does that mix of assets and capabilities and the scale of particularly the credit portfolio give you an edge in investing in the technology sector against other private equity firms who may not have that deep sort of credit and infrastructure finance experience?
Yeah, I think it's I think of it as about a little more than $700 billion of AUM, of which, like you said, about $550 is credit. 130 or so these days is private equity, and the remainder is what we call hybrid, which again, and there's real estate in there, I think in the equity sleeve, but hybrid, and we'll talk about hybrid because it's a really important part of the sleeve. You're exactly right. It is it's a real differentiator, and there's the growth in the business of Apollo, but then there's the how does it make us better as investors. If I was just thinking out of my private equity with my private equity hat, we'd never have the scale or the relevance to do be talking to Intel or talking to some of the largest companies in the world that I talk to on a regular basis. And so what it means is we just have more tools in the toolkit. So I'm going, as part of like other partners at other private equity firms, my day job is meeting with CEOs of scaled corporates, on a constant basis, and I can go to them and really have the conversation around, again, like I was saying earlier, either we're, here's the buyout option, here's the other option, and here's all the way down the spectrum. Most of our credit business is IG, right? And really plain vanilla financing. People think of our credit business for some reason still as this, the old Apollo distressed, whatever. But that is not the business we're in credit land. So that's one way it helps. The other way it helps is we just have tremendous visibility into, our credit guys. We're probably the single larger, or we're among the top buyers in our loan and high yield markets. And so what that means is when I'm looking at a sector, I'm getting up to speed on a sector. If we haven't spent time on it in private equity,
You've got a team on a credit team.
Yeah, I'm calling my partners in credit, and we're getting smarter, and we're and they're seeing a lot of flow, and so it's super symbiotic, and I actually love working on the kind of cross-platform stuff.
Now, at your Investor Day, fairly recently, Mark Rowan talked about the sort of five-year plan in terms of growing AUM and put some big targets out there for 1.5 trillion by 2029. And within that, you've got a almost tripling of your private equity AUM to about 270 billion. That's at least the target that was stated publicly. Can you give us a sense where that growth is going to come from?
One of the really great things about working in a place with Mark as a leader is, again, just the way he thinks about innovating and business building is probably unmatched on the street. So here's the answer. Today, our private equity business is still a core critical part of our firm, but it's mature. So as we think about the building blocks of growth, private equity is our critical, stable, intellectual, center in a lot of ways, but it's mature. So different businesses in the equity ecosystem, to your point, the broader equities that are going to get us to, the tripling of the equity business.
Where you were going direct to very large family offices, now you're going to high net worth.
Well, that's true.
And you extend further down as well.
Totally, a slightly different point, but yeah, that too is not just because I mean, even with our massive sovereign wealth LPs, we're thinking about them more as clients than we ever did before. But yeah, you are making a separate point, which is exactly right. We're also, retail is going to be a huge. I mean, everyone's focused on retail. I mean, if you look at, we've got some wild stats. I mean, at our firm, 2 or 3 years ago, we had something like 0 people focusing on the high net worth channel. Now we've got like 150. I mean, it's just been a whole new initiative for us. It's going to be a big driver of growth going forward.
Let's spend a moment on private equity, the classic
my day job still.
The classic buyout strategy. Yep. So we've had an opportunity to be alongside you on a number of transactions, and when I think of you from the outside, you're often described as a value player, right? So your average creation multiple, publicly stated, is 6 to 7 times. You're typically putting 3 to 4 times leverage on these businesses, so you're very reliant on sort of operational cash flow generation to drive returns. You also have done really well with that strategy, and I think in some of the public discussion at the Investor Day, there was an interesting stat that showed that most of your returns come from operational improvement versus multiple expansion and other things. So that strategy is different than a number of the other tech P players. You're coming in at lower multiple, typically more mature businesses. And what is it that what is it when you have that strategy within technology? What are the good fits for those types of investment parameters? What kind of companies? And then my second question to that is when will you ever kind of go up the chain into higher growth? Is there a path to a different model within private equity in the next couple of years?
Like you said, so our core private equity strategy is it's a value-oriented contrarian strategy. We go to market. You're exactly right, Antal. We think about purchase price matters in everything we do. The average LBO multiple is 12 and change. Our creation multiple, as you said, is 6 to 8. Historically, as we thought about sources of value creation, exactly as you said, the things that we focused on were, one, creating value on the buy through just multiple buying at below fair value, and 2, free cash flow, and then 3, cost saves or operational improvement, like you said. I think in tech, what we've done, what I've tried to do in my deals is, again, you guys have been involved in all of them, or almost all of them, is value on the buy, growth once we own. That's kind of my approach in tech land. Is let's create something that's got real downside protection with cash flow and purchase price. So we'll talk about Yahoo, we'll talk about Shutterfly, we'll talk about all these other deals, but let's make sure that now that we own it, it's a tech company, and we're going to have to exit it to a buyer who's going to get excited about the terminal value and the growth for them. And so we're going to have to make investments that I think when I was growing up at the firm we may not have made once we owned it. And so that's really the value on the buy, growth once we own is really the approach that I bring to tech investing. And the second part of your question, no, you're not going to see us we're never going to be a mid-teens buyer or a 20 plus, times EBITDA buyer of a sexy software asset. It's not going to be us.
Okay. So hybrid value, you started talking about it. I've in my interactions with Apollo seen some very different flavors of capital solutions that might come to bear with hybrid value. You've done converts. You've done instruments that look more debt plus warrant like. We've also come to hear your name more often in pre-IPO solutions. Mm-hmm. Can you tell us a little bit about the breadth of what hybrid value can bring to the table in different situations? Right? It might be in a distressed situation during the pandemic, but it might also be a solution on a path to an IPO, for example. So a little bit of color on what you're trying to do there would be great.
Yeah, I mean, you summarized it really well. I'm trying to think what's additive, but yeah, it's exactly like you said. We are. This is a strategy that we started. It's a lower cost of capital strategy than our private equity strategy, so we can be very competitive with corporates. In terms of when we're competing against a private equity oriented 20% plus return capital, where hybrid value is more in the kind of mid to high teens, really mid-teens cost of capital. Exactly like you said, there's a lot of ways to get there, right? So that is everything from heavily structured returns. You then will have on the other side of the spectrum stuff that's a lot more equity-like, that doesn't have a coupon, but it's hybrid value because it's got structural downside maybe in where it sits in the cap structure. Maybe it's got a put right, or maybe it's got something. And so you still have to believe in the equity value appreciation, but at least you've got downside protection. I mean, it's a strategy where, obviously when you've got a strategy that's lower return targets, you just have to be very, very focused on capital preservation. So it's a strategy that cannot have capital loss, and so it's got to be structured. But that the returns can be generated with a lot of flexibility as you think about the tools between coupon pick, OID, equity returns, and exit mechanisms.
I'm gonna read to you one quote from Mark Rowan. Again, lastly from your Investor Day, but just to get your comment on it. He said the ability to originate assets that offer alpha or excess return is the key driver of Apollo's business going forward. And he also quoted, he said that one of the key KPIs he looks at is the amount of origination per year, which he expects to go from about 160 billion per year to 275 by 2029. We hear a lot from private equity that they are looking for innovative ways to originate, and that can be through relationships with founders in some cases. It can be by building relationships with investment grade companies. But as you think about your own strategy in terms of being able to drive origination and not wait for banker processes to come onto your desk, right? What is your approach to kind of driving origination at Apollo?
Yeah, so let me answer the question big picture, and then I'll talk about my approach for origination. So when we say origination, and when Mark says that, it's because we put ourselves in a fortunate position through Athene where we have, no shortage of capital, shortage of assets, right? So just for folks who aren't familiar and are listening, right? So Athene is it's in a handful of businesses, but the most basic is just in the retail annuity business. And meaning, Antal wants an annuity, 30 years guaranteed at 5.5%. You'll pay premium up front, and we'll give you that annuity over time. So our job then is over a long duration with, it's very highly regulated, but rated, matching, and generating some excess spread to the liability. Yeah. Okay. In a year, we are going to do $70 to $100 billion of capital inflows through the insurance business. Right, so so we are, like I said before, I think of the entire credit business, about $400 billion is our own, insurance business, and again, that's growing to the tune of 70 to 100 billion plus per year, and sometimes in excess of that. So that's on the capital side. So when we talk about our origination business, which my close friend Chris Edson just got promoted to run, that's, and I'll get to that. That's me and some of our stuff, but that's also in terms of my day job and originating assets for that. But that starts with the platforms that Chris and the rest of the team have built over time. We have 16 platforms now originating. We have Wheels Donlan originating auto finance. Yeah. We have Alliant originating inventory and receivable finance. We have PK Aero. We have doing aircraft financing. We have MidCap doing low mid-market. So we have originating takes lots and lots of forms. All of our real estate stuff, real estate credit. So that's kind of almost half the origination, maybe a little more than half. And that sits on the primarily the Athene balance sheet. The other side of origination is the more deal-oriented, type of thing. So we'll talk about Intel. We'll talk about AB, AB InBev, Intel, very large deals or originating assets that make sense for the balance sheet. Okay, so that's what Mark is talking about. To your question, how I focus on my origination. Look, I think that, like you said, we have a pretty young, scrappy partnership at Apollo. Like I think everyone says this in terms of not participating in auctions, but like we really don't participate. Like it's very, very unusual that we're competing with someone else. So it is, I am, again, my day job is being on the road, not dissimilar from you, meeting with CEOs, building relationships with management teams, obviously being in the flow with all of the right banks and the right folks in the industry, spending time with management teams that are, independent, developing their own theses. So that's what I love doing is just being out there. People make fun of me that, I have lunch at Nobu every day, but that's because I'm meeting with a new CEO or, our management team or building relationships with bankers every day. So that's our core. That's my job.
Okay. We're going to get to hear a little bit more about how you do that in practice now and what we call the anatomy of the deal segment.
Great.
We'll deep dive into a handful of your key Apollo tech deals now. And so we're going to start with we're going to start with Intel, right, where you provided $11 billion of capital earlier this year to fund what they call Fab 34 in Ireland. This deal from the outside looked like you were buying 49% of the equity of, it wasn't clear whether it was the entire fab or some kind of operating JV around it. But you described the deal as equity-like. And it'd be interesting to hear a little bit more about how this was structured and how it works for Apollo and how it works for Intel. Yeah. And the second piece to this question is like, what other types of businesses can this type of financing structure apply to? This is obviously an investment-grade partner. You've got a lot of financing right now of big data centers driven by AI. So it'd be interesting to hear a little bit more about the applicability of this solution to other situations you might encounter.
Totally. It's a really exciting one, and I think gives a good glimpse into everything you just said and how we think about the world. So, stepping back, as you think about the semiconductor ecosystem, there are really three guys in the world that make leading edge chips: TSMC, Samsung, Intel. Historically, TSMC is of course a foundry for third parties. Samsung is a little bit of both, mostly themselves, but they supply third parties. Intel has been an integrated device manufacturer. They just do it for themselves. Pat Gelsinger comes in, launches IDM 2.0 strategy, where they're going to create a foundry business to provide chips for other customers. Making a fab, constructing a fab is insanely expensive. Insanely expensive. A new fab at leading edge is fab is a factory. A new fab at leading edge is $25 to $30 billion. The EUV lithography tools, you could see a tool out of ASML being $250 million. And, Fab 34's got like a dozen of them. I mean, it is the scale of this is just insane. Intel, as part of their fab, their IDM 2.0 strategy, they were looking to raise the Fab 34 net of government incentives. They needed about $22 billion for their Ireland fab. And they were going to do 11 of it, and they needed 11 from someone else. Having covered the space for a number of years, I knew the team over there very well. We had a great long-term relationship. I'd known Dave Zinzer since his Micron days, the gentleman who runs strategy over there since his Xilinx days. So, we were really deep with the company and really respected them and admired them. We also, so my partner, Jamshid Hassani, who's, an amazing leader and runs our entire, most of our insurance franchise and this business that we call High Grade Capital Solutions, had this product, this balance sheet that Jamshid runs. And so it was a partnership, between kind of, between us and a handful of other folks on the team, Joe Jackson and others. Without getting too technical, so Intel Fab 34 produces wafers. Mm-hmm. Two types of folks buy those wafers. One is Intel for their own products, and two is another customer. We said to Intel, okay, why don't we create we'll put a JV, and we'll create a JV, and the JV exists for the sole purpose of operating Intel Fab 34, but it sits in the middle of Intel, the design company, the product company, Intel, the fab. We'll pay $11 billion to buy 49% of that JV. At the same time, Intel, the design company, buying wafers out of the JV, will sign up to a long-term minimum volume commitment. Okay. Where they have to buy a certain number of wafers outside. So Intel Corp is committed to buy a certain number of wafers outside of from the fab, and it flows to the JV. To Apollo, we can price that as debt because we said, okay, great. We're taking Intel credit risk. They had this minimum volume commitment. The Intel bonds traded to about a 5.5% yield, so we can price this to only a couple hundred basis points wide of the Intel bonds. Wow. So it's an IG financing. Again, it can't be totally debt, so there's a lot of nuances here, and I'm simplifying, but effectively taking Intel credit risk. So we're for the same risk that the bonds have. And we even have some structural seniority of the bonds. We can get into it, but we're earning an excess spread. As Mark always says, excess spread for unit of risk. So we're earning in this instance, call it 250 basis points of excess spread on $11 billion of capital. So really big, really important for us. Intel can go to the rating agencies and say, Apollo bought 49% of the JV. That's equity. They bought 49% equity stake in a JV. And not that we're tricky. I mean, rating agencies are super deep alongside us. They understand every nuance of our contract, but it is equity to them. We can price it as debt, and the competitive solution in that instance was a large private equity firm with an infrastructure fund. So they were going to do $3 to $4 billion of equity, infrastructure equity, so mid to high teens
pricing
capital,
in mid-teens, yeah,
mid-teens capital, and then they were going to have debt that sat on top of that. So you mean 3 plus 8 or so equity plus debt to get to the 11. But it's just not, the weighted average cost of that for Intel would have been, low double, like just wildly not competitive with our capital. So, and all that sits on our balance sheet, right? And we syndicated some of it and we got it rated, right? So it's IG, so it's a long duration, bespoke piece of paper that literally 0 other people in the entire world could have done. All right, super exciting. Great partnership with Intel. What does it mean for other things? There are a lot of the industrial renaissance and the CapEx renaissance and everything you got going on. There's going to be a huge need for this product. So I think that this is just, anyone who is IG or close to IG and has offtake and needs capital at scale for long duration, it kind of feels like this is like what Mike Milken was doing in the 80s, inventing the high yield market. Like this is that's how excited I am about that product.
Fascinating. We're going to see more about that, I'm sure, in the next couple of years. Let's go to Yahoo for a minute.
Yes.
So this was a pretty complex digital media carve-out. You structured it, again, in an interesting way. There's various different assets underneath the Yahoo umbrella, ranging from the core O&O owned and operated business that everyone knows as the Yahoo brand, to a membership business, to an ad tech business. Tell us a little bit about how you went about doing this deal and how you structured the deal to make it compelling for Apollo. And also, we'd love to hear how it's going, obviously.
Yeah. All right, I'll do the obligatory plug. LionTree advised us on it and co-invested on it, and it was great. It's a great partnership with LionTree. Yeah, I mean, this is a really it hits all the kind of vectors of what Apollo does best. So we had been very close to Verizon for a long time. We knew that they were going to have to change strategy at some point and sell their media assets. So, they had built over a long period of time, the collection of media assets, ad tech assets, and it all sat within this kind of Verizon Media Group umbrella. They were looking for one partner to take on the entirety of Verizon Media, as you remember. Look, it makes sense for them, right? They multi-$100 billion enterprise value company. They didn't need to get the extra $1 billion. They just want to shift strategy and have one partner deal with the entirety of it, as opposed to selling off individual pieces, which they knew they could have done as an alternative to maximize value, but it would have been painful. We were really the only party that made sense for that. It's exactly what we do. Super complicated carve-out, scaled, value-oriented. So we ended up buying it for about $4.5 billion, a little more than 4 times EBITDA if you include cost savings. Really attractive purchase price. But what I'm most proud of up front of the structuring is, like you said, we structured this in a way where we could finance different silos separately and create a situation where we could return capital very quickly. So, there are really 5 businesses that sat within Yahoo when we bought it, or Verizon Media when we bought it. One was Yahoo, so the owned and operated internet media sites. The Yahoo is the second most visited website on the internet still, believe it or not. 700 million MAUs, huge scaled platform, first-party identity graph, etc. Mail, sports, finance, home, search. That is where the debt sat. So the syndicated term loan sat only against the O&O EBITDA at Yahoo. So we created that silo. That's where the financing was. Intentionally, because I wanted to make sure that we could de-risk the deal by selling things quickly outside the credit. So that was where the debt sat. So outside the credit sat the rest of the businesses. AOL, $300 million of EBITDA still. Actually, it's grown since we did the deal. It's now close to $400 million of EBITDA. Yahoo Japan royalty stream, we'll talk about in a second. We earned that was 3% of Yahoo Japan's revenues for using the brand in Japan in perpetuity. That was about $120 million cash flow stream. There's a content delivery network, as you know, mini Akamai. And then there was the ad tech business. Because those last 4 businesses sat outside the credit, what we did day one is effectively day one on the first couple, really months out of the gate, we closed in the fall of 2021. We sold Yahoo Japan a month later for $1.6 billion. It sat outside the credit, so that went entirely to the equity. we sold CDN, we sold some other things. And so really within the first kind of 6 to 9 months of the deal, we'd been fully realized on our entire $2 billion of equity. And we still owned the most important pieces. We still owned, O&O, AOL, and ad tech. And so, it's kind of phase one of the deal was, with the financial engineering, which, I think some people think of as a 4-letter word, but we're proud of being very good at that aspect of the deal. So we bought Yahoo for free. And then this goes back to what I was saying earlier. Then the next phase was, value on the buy, growth once you own, right? And by the way, I don't want to minimize. Like it's an insane amount of work, and we're not done. We got an insane amount of work ahead of us. So I certainly there's nothing to celebrate until we exit. But we hired Jim Lanzone, who's been an amazing CEO. We've really, put a lot of money into investing in the team. We've upgraded, we have an amazing management team. We have GMs of each of sports and finance, and home, mail, news, who run them as basically independent businesses. We've done really strategic things, at Yahoo Sports as relates to the betting side of things. We have at Yahoo Finance, bought a company called Common Stock and a lot of really interesting things there. So a lot of momentum in the core business. So phase one was kind of, we did a really nifty deal with Taboola, so we could spend a whole podcast on just Yahoo. But so phase one was the financial engineering. Phase two was really bringing in Jim and investing in talent and growth and, creating value, improving product, et cetera. And phase three, which we are kind of in the midst of now, is, getting, really thinking strategically about, strategic partners, M&A, continuing to grow the platform, selling some small things here and there. And so, like all private equity deals, what really matters is cash, at the exit. But so far so good, and it's a really, really fun one. And I love the company.
I want to just get a very, very quick take on another deal you did, just to kind of show the breadth of solutions, right? So you invested in Western Digital as well, right? And this is a more classic convertible transaction for a company that was coming into a good part of its investment cycle. You did some interesting things there in terms of separating the business under your investment position. A little bit of interesting dynamics around how that might have come together and how that's going.
Yeah, so like you talked about, you asked about origination and how we think about origination. So this is one where I had built a really close relationship with the CEO and the team there. We'd followed the company for a long time. It was a large IG public company, $20 billion market cap that was going through a period of transition. And it's got two businesses. One is the hard drive business, and the other is the NAND semiconductor storage business. It is if you think about storage globally, about a third of all storage on a Western Digital device. The drive business is a very, very good, stable business. It's really WD and Seagate, and then Toshiba to a small extent. The NAND business has the potential to be a very good business, but can cycle very hard. It's a cyclical semiconductor space that has Samsung, Hynix, Micron, et cetera, Kioxia, so a bunch of different players competing in that space. We came in really at the trough of the last couple of years for this company. Both segments were cycling hard. The stock was in the high 30s. We invested just under $1 billion in a large pipe. I joined the board. It's what we do. We worked really closely. That actually was invested out of our private equity business. Even though it's a there's some aspects of it that are hybridy. Really, like I said before, there's different ways, a lot of different ways to make money in these securities. This one is really it was an equity bet. And we basically, became the deal team along with David Geckler, the CEO, and some other folks on either separating out the two companies or doing a spin merge with one of the businesses. And long story short, we successfully, worked with the company to split into two, create a lot of value. I'm still on the board, but we've fully exited that position. In a little more than a year, the stock made its way to kind of the 80s. So we exited, and it was a really, again, a great investment for our LPs, but I think a great answer for the company and for the management team, and so kind of win-win-win all around.
Fantastic. Fantastic. We're gonna focus for a moment on what comes next in 2025.
Okay.
Obviously, we've just been through an election cycle. We're going to end up in a new political environment next year. It seems like there's a growing flow towards more activity in 2025. We're hearing from a lot of folks. At the same time, we remain in a large cap tech bull market led by AI that is only now beginning to kind of filter down into more of the mid cap. How do you look at the opportunity in 2025 for you across all these different tools that you have, from private equity to hybrid value? Where are the opportunities, and what are you most excited about?
I agree with you. Activity is, it just feels, there's no other way to say it other than it feels like the animal spirits are kind of back in a bunch of ways. And, if you look back on private equity activity, as you know, it's been pretty muted, right? I mean, you had, obviously what maybe not will be an anomalous year in 2021, which was just a massive year for everybody on the buy and on the sell. 22 was the collapse of that. 23 was people kind of picking up the pieces. There was no financing, so no LBOs got done. And then people came into 24 saying 24 is going to be, a big deal market. And for a whole bunch of reasons we can get into, I know we're getting close to time, it wasn't. I think 25 is going to be the new 24. I think that we are seeing already in our business, real pickup in activity in terms of just inbounds, NDAs we're signing, stuff we're seeing on the buy. On the sell, I think, right, the industry has $3.2 trillion in assets that sit within private equity portfolios that have just kind of been stuck. And it feels like the floodgates are going to start to open, and there's the sponsor-backed IPO pipeline is really deep right now, and so I think you're just going to see a lot of people are going to have to start transacting. So what it means for us, I think so the private equity business will be busy, especially in an environment where there's also a bunch of folks who are still too levered. There's going to be a huge amount of deleveraging opportunities and deleveraging capital needs that are going to come out of hybrid value and hybrid type products. And so I think that, right now, I think right now the investing environment, in fact, for hybrid is maybe the best part of the cap structure, where you've got equity convexity but have downside protection relative to a very, like you said, a very expensive equity market. But look, I think point being, it feels like after a couple of years of real muted activity, 25 is going to be busy.
One last question for you that impacts your portfolio, and then we'll do the lightning round to wrap up. The question of AI has come up in a lot of our podcasts, and we've begun kind of having a lot of debate with private equity on what it means for their portfolio companies and what it means for investment strategy going forward. It adds disruption, obviously, and if you're in people-heavy industries, it can have a lot of profound effects on the way you operate. But what's your take on AI, both within your investment strategy in tech, but also more broadly across the Apollo portfolio? What impact is it expected to have? Yeah.
So look, again, I go back to what I said earlier. Like we are not thematic, growth investors, right? So we're not the guys here who have. I'm not going to profess to have the most sophisticated view on every layer of the AI stack. Clearly, it is a really important part when we're looking at new companies. It's a really important part, especially in a lot of the stuff, kind of things we look at, like what is a disruption risk, and how do we box that disruption risk? And that's across consumer internet, that's across some of my media sectors, that's across some of the other parts of tech. It obviously also has the opportunity to be a cost opportunity, right? And so I think right now it's probably in my world more as I look at new stuff, more disruption risk than kind of tailwind. The Apollo approach is, we're and I'm part of our, we have a team focused on AI across the portfolio and opportunities to use AI to, enhance the portfolio. We have a very, very large portfolio of companies, as you know, and so. We have one of my partners in our apps business, which is our kind of internal operating partner business, is basically full-time focused on, using AI to help portfolio companies. And, we have been, others have taken the approach of hiring a whole bunch of internal folks. We've taken the approach of being kind of lean centrally, but relying on, without over-investing and relying on kind of third-party partners to help us across the portfolio. But we have a whole work stream in flight, and it's something we've communicated actively to our LPs around, how we use AI to create value across our portfolio.
Fantastic. We're going to finish up with some fun lightning round questions just to wrap up. But 3 ones for you. What's one of your favorite recent travel destinations as we head into the holidays here?
Okay, but I just realized I'll answer. So Kenya is the answer with my family. We didn't get to the personal part where I've got a 7-year-old, a 6-year-old, and a 4-year-old.
We didn't get to that.
And a wife. We were all business on top. But so part of the crazy thing that we do as a family is we take our kids everywhere, travel-wise. It's really important. I think my 7-year-old likes to tell people he's been to 20 countries. And so at the end of August this year, one of the places we took them this year, but they've been to a bunch of other countries this year. But we did safari in Kenya.
Fantastic.
And with a 7, 6, and 4-year-old, and it was amazing.
That's amazing. What about a favorite book you've read this year?
So I had never read Ayn Rand's The Fountainhead.
Love that book.
But so I actually read it on that Kenya trip. But so I've got so I think we're all trying to be a little more Howard Roark and less Peter Keating.
Now on to Atlas Shrugged.
That's next. I've never read that one.
Okay. And then favorite podcast to listen to besides KindredCast, obviously?
I'll confess, I like Prof G. I like Scott Galloway. I also, I like the Dan Senor Call Me Back podcast these days.
Fantastic, Reed. Thanks for the time today. Happy holidays to you all. Really appreciate it.
Awesome.
Thanks,
Antal. Okay.
Thank you for listening. Stay tuned for more KindredCast conversations from leaders in business and beyond.